Hi class, in this video we're going to look at an example from chapter 4, and this particular example has to do with reconciling a bank account. So in this question it says, Oscar's Red Carpet Store maintains a checking account with Academy Bank. They sell carpet each day but make bank deposits only once per week, and we've got some information. This is from the company's ledger, so these are the company's records. And then we've got some information from the bank statement here. So it says, prepare a bank reconciliation for Oscar's checking account on February the 28th, 2018. So the first thing I'm going to do is put in my bank statement balance and my general ledger balance, and this is for cash. So this says the ending cash balance recording in the bank statement is $11,755. So pretty straightforward. You're just going to type in the balance. So that's what the bank is saying that the company has. And it looks like the company says they have $7,600 on their books. So obviously there's a difference, pretty big difference. So the purpose of the bank reconciliation is to identify the differences and hopefully make sure that those differences are legitimate. Now, usually the bank balance and the company's balance differences are most often due to timing differences. It takes a little while for, after you write a check, for it to get through the mail to whoever you're paying, and then for them to cash it and that check come all the way back to your bank and be presented at your bank for payment. So there's a lag for a check that's written. There's also a lag sometimes for deposits that are made. So if you put a deposit in the night deposit box, you know you made a deposit today if you did that today, but the bank's not going to know that you made a deposit today until they open again and find that deposit in the night deposit box. So if it's Friday evening, then the bank's not going to even know about that deposit until Monday. So there's a time difference between when you record the deposit and when the bank actually receives the deposit and records it. So a lot of times the differences are just because there's timing differences. So let's look at our bank statement side first. So we're just going to be looking at the bank statement information, and we're going to be looking for things that are not on the bank statement but that the company has recorded on their books. And there's usually two main things that we're going to look for, and those are deposits in transit. In other words, we made a deposit but the bank hasn't recorded it yet, or outstanding checks, which are checks we wrote but the bank has not received them yet. So let's see what our instructions say. We already took care of item A. Item B says cash receipts of $1,350 are outstanding. So the bank has not received $1,350 of deposits that we made. So those are deposits outstanding. And when the bank gets those deposits, they're going to put them in our account. So whatever balance the bank says we have is going to go up. So that's going to be an addition to the bank balance. And then we're to C, it says checks 325 and 327 are outstanding. So it doesn't look like they're requiring us to put those in separately. So I would just suppose we're going to add those together. So we don't know how much they are looking here, but if we go back up to our books, we should be able to find 325 and 327. So looks like $1,850 if we add those together. And when the bank gets those checks, they're going to take those out of our bank account, and so that's going to be a minus, a subtraction. And so I can't do this in my head. Let me get my calculator and see what our balance is, because that's probably all that there is. So it looks like I've got a balance of $11,255. Sometimes there's something else on this side besides deposits outstanding and checks outstanding, and that is if the bank makes an error. So let's just see, make sure. So I took care of A, B, and C. So we are to D, that's an NSF check. E looks like an error on our part. So if the bank makes an error, we're going to put it on the bank's side. If we make an error, we've got to fix it on our books. I don't see anything else that would be over there. So all of this information here is information that the bank has correctly recorded that we haven't recorded. So starting from D all the way down, the bank has recorded that and what is on the bank statement, but we haven't listed those things. So we're going to have to make adjustments for all the things that the bank has recorded that we haven't. All right, so let's start with D. It says the deposit includes a customer's check for $200 that did not clear the bank. So in other words, we received a check from a customer for $200. We made a deposit, so we recorded a deposit for $200. But when the bank tried to send that check through the customer's bank account, the check bounced. It wasn't any good. So when that happens, the bank actually takes the money back out of our account, because they kind of front us the money when we deposit it. So they put $200 in, and then when they tried to collect $200 from the customer, they couldn't. So they're going to take that $200 out. So we need to take that $200 out on our books. So when we got the bank statement, we would have seen that NSF check, and we would know that we need to take that back out of our balance because we deposited $200 that wasn't there to be deposited. All right, E says check 323 was written for $2,800 for advertising in February. The bank properly recorded the check for this amount. So check 323 says we wrote it for $2,250, and it should have been $2,800. So we made an error when we recorded that check. It looks like a $550. So we only took out $2,250, and it should have been $2,800 because it says the bank actually had the right amount. So this amount's right. This up here is wrong. So we need to take out $550 more for that check. That was our error. I would say they're calling that a company error. And F says an automatic withdrawal for Oscar's February rent was made on February the 4th for $1,300. So that's money they took out of our account that we might not have known about until we got the bank statement. So we need to record our rent. Then it says we earned interest of $175. So that's in addition to our checking account balance. And then H says in January, one of our suppliers borrowed $5,500 from Oscar. And then in February, which is the month that we're doing, that borrower actually paid us money back. So paid us $56.50 right here. So let's see how they're doing that. Looks like they've got separate things for the interest. And somewhere there's probably something for a note. Yeah, note collected and interest. So the note was $5,500, and that's going into our account, and the interest is going into our account. So those are both additions. And let's see, that takes us to I. Academy Bank charged service fees of $120. So they took $120 out of our account. So that's a subtraction, and those are some kind of bank fees or service fees. And that was all the way to I, so there shouldn't be anything else. But let's add all these together. Add and subtract. All right, and when I add and subtract all those, I get $11,255, which is great news, because what I want to see is this balance over here being equal to this balance over here. So the gist of that is that I have identified all the differences in our balances, and when I adjust the bank balance for the things that they're going to get at some point, if we kind of accrue them back to this point in time, which is where they should have been. And then when I make adjustments to my books for all these things the bank did for me, either collected money or took money out, so my books should have reflected all these items of income and expense, then I would have this. So I'm kind of accruing those differences to each side depending on which side needs to be adjusted. So we should be in balance, and we are. That's good news. And so then this one's tied to that. It says record the necessary cash adjustments. So we've got two entries on this one. We've got record the amounts that increase cash, and then the other ones record amounts that decrease cash. So I'm not going to do those. I'm going to let you do those, but just wanted to give you some guidance. So when you finish your bank reconciliation, you need to do journal entries, but only on the adjustments that happen over here on the company's side of the bank reconciliation. This stuff that we adjusted over here on the bank side, those items, this is a deposit outstanding and there's a check outstanding. Those items we've already recorded. Those things are already up here in our ledger. We don't want to make any more journal entries because we've already recorded those. The bank hasn't recorded them simply because the bank hasn't gotten the items yet. So there is no journal entry that we need to do for the bank side. This is the bank's responsibility for recording those. The only journal entries we're going to do are over here on this side, and you'll have to do a journal entry for everything that happened because all of this stuff these are all transactions that the bank recorded that we did not record yet. So because there are actual transactions in our account that we have not yet recorded, we need to, when we finish the bank reconciliation, go ahead and record those, and that'll bring our balance up to what it should be currently. So the way this is structured, it actually has two entries, one for the additions, which would be your interest on the account, your interest on the note, and the note collected. So those three things are bringing cash into your account, and then all the rest of these are taking cash out of your account. So you're going to lump those in two categories and do two journal entries. Of course, cash into your account would be debit cash and credit the appropriate accounts here, and then for cash coming out, you would debit the appropriate accounts for each of these lines and credit cash because cash is going out. Just one more note, this NSF check, when a customer writes you a check for their account, you're going to credit their accounts receivable. If their check bounces, you're going to restore the balance on their accounts receivable because they still owe you the money. So you credited the accounts receivable when you showed the payment. When the payment doesn't clear, you're going to have to debit accounts receivable to put that amount back in there. So that's how that NSF check is going to work. I think the rest of it's pretty straightforward. So I hope this helps. As always, if you have questions, feel free to ask.